I actually think there are too many people who are trying to be entrepreneurs. It's an overfunded asset class. And so the question always is, why does the world need yet another venture firm?
What would be the most important one or two things that you would like to point out? Consider these two things before you take this decision.
You have to know whether you are comfortable being lonely in a very, very lonely business. What type of a portfolio do you want to build? Are you going to make controversial decisions? What has changed because of AI and because the very nature of software development itself is changing along the way is that teams are getting smaller. The best and most interesting technical projects in the world have always been done by a two-pizza team. The most important person is now 10 times more important. In other words, is now 100x more important.
Welcome, Ashmeet. So excited to have you on this show, and thank you for taking the time to have this conversation with me, and welcome.
Thank you for inviting me.
You and I go back a long time. I think we've known each other for many years. We have a lot of overlapping connections and obviously also investments. But you are actually extra special guest on this show. Do you know why?
I'm honored, but I don't know why.
Okay, so besides investing similarly and together, you are also a connecting glue to my partner in the business, Anshu Agarwal. So you and I both backed Anshu at Nimbella, an exceptional founder who built that to success, sold it to DigitalOcean, and then we recruited her to Converge. So that's our extra special connection.
That's right. I was very grateful that she chose me as her first investor. And obviously both of us made money and did well. So that's the extra bonus when you make an investment. She is a special person, no question about it.
And we are continuing to invest together, which sort of, has given me some deeper insight to who you are and how exceptional your story is. Maybe we can double click a little bit on why you as an investor are quite unique in the business. So when you started out in 2015, you were at a very established firm, Foundation Capital. I don't know which Roman numeral they were deploying at that time. You probably remember, but it was
5, 6, and 7.
5, 6. Okay. So, for someone in the business to leave 5, 6, and 7, where it's easy to raise 7 or 8, much easier. It's easier to attract talent. It's easier to attract founders. Leaving all that and starting with 1 is a bold decision. You did that. And you were different from others who were starting in the business as solo GPs at that time, as in you did that with institutional capital, right? So take us back to that moment. Why did you decide to leave Foundation, and why strike out with a small 1 when you could have been part of 8, 9, 10, 11?
Yeah, as you can imagine, it was a very difficult decision because I had been one of the managing partners at the firm for the last couple of years when I went to Catherine, who was the founder of Foundation Capital. And I said, Catherine, I'm not really happy. And she was like, okay, you've made money. You've got a good portfolio. We know we're going to make money. What's the issue? And she was an incredibly insightful person. Not only was a great investor, obviously had started Foundation Capital, but she told me that happiness comes when you can find the intersection of what you're good at, where there's a market opportunity, and what you enjoy doing. And if you can find the intersection of those 3 things, that's when you become happy. And so she helped me design Engineering Capital. And she was my first LP, obviously a mentor, person who taught me venture capital. And many of the decisions can be traced back to the walks that she and I took in Portola Valley. Just talking about, everything from the meaning of life to how do you make money. And what makes you happy. So, I can talk about some of those decisions and the structure and sort of the insights that she had. And she started with always the most basic question in venture capital, which is, it's an overfunded asset class. The average venture capitalist doesn't make money. It's only the top firms that really make money, but they make so much money that it makes up for the rest. And so the question always is, why does the world need yet another venture firm?
So true. And what was the answer to that?
The answer is it doesn't. And so you really have to find a way that you can serve a set of entrepreneurs better than anyone else. And so the question becomes, can you identify entrepreneurs who are being underserved, who you can serve better than anyone else? Why should they choose you when they have an offer from a, traditional classic tier 1 sandhill venture firm? And once you can answer that question, then it becomes much easier. Everything else then sort of falls into place. And for me, that answer was very simple. If you're a person with a technical insight who wants to take technical risk, at the very founding stages, I believe engineering capital is one of the firms that can be your best choice to start your company with.
So a gap in the market. So I want to come back to that, which is a very important, you're a hyper-specialized investor and that has led to a lot of success. And there's a very important lesson there. So before we go to that, just going back to, launching your own firm, starting with Roman numeral 1, building up from there, and then choosing to stay a solo GP. There are pros and cons here. I'm sure you thought about, or maybe didn't think about, expanding the firm, adding more team members, becoming another foundation, right? So, but you have chosen to stay solo. And what has been the driving decision behind that?
Yeah, so being a solo GP is sort of an idiosyncratic choice. That's more about me as an individual and where I ended up. Truth be told, I wasn't planning to be a solo GP. I actually wanted to build a partnership. And in fact, if you look at the very first deck of engineering capital, on the team slide, I have myself and then I have a blank icon which says, future partner, bachelor's in computer science, MBA, startup experience, a bit of a nerd, geek. Those are kind of the characteristics that I was looking for. And I actually came very close to two people. One of whom she's now a GP at another very nice firm and ended up, staying in the venture business. So this was not something that I planned. Being a solo GP is not something that I planned. But again, going back to Catherine, I didn't have a partner when I decided to start engineering capital. And that, as you know, is a very important, very difficult decision. You really want to choose wisely and carefully when you do that. And so I was like, well, I could take 6 months to a year, find someone who I really, really like. And Catherine's advice was, what are you waiting for? Make money. As long as you're making money, everything else is second order. You can figure that out. Our job is to make money. And so she would always reduce everything to this, are you making money question. And so a partner really is optional in terms of making money. And in this case, I chose to stay that way, like I said, for idiosyncratic reasons. I'm an engineer. I'm a bit of an introvert. As my wife likes to say, you're better off talking to a computer than a person sometimes. And it just evolved that way. And once I got comfortable, I also found it was much more efficient. I could be successful. The LPs were supporting it. So everything fell into place. And then at this stage, it's like, don't break, why fix something that's not broken?
That's not broken. It's working for you. Very important. I was talking to another similar partner like you who also struck out, and he came from a broad partnership. And for him, it was all about speed of decision making. Right? Partnerships can be helpful. Sometimes they can get in the way. There's sometimes, too many checks and balances put in place for the right reason can get in the way of speedy decision. So maybe that's another, big advantage, particularly to founders you're backing. You decide quickly.
Speed of decision making is definitely one of the benefits of being a solo GP. It's not the only benefit. Speed is also a competitive advantage in the venture business sometimes, but I don't believe speed is a dispositive factor. I think partnerships can be very fast. I've done deals with firms, large firms, some of the largest firms on the planet, and I am always shocked at how fast they move. You don't have to wait for the Monday partner meeting. You get the call from that partner 3 hours later when they're serious. When you don't hear back, when they're not moving fast, is when you know that it's not working out. And just for the record, I think it's very important to state that staying a solo GP continues to be a controversial decision for me. I have two great mentors after Catherine, Jim Anderson, who was the co-founder of Foundation Capital, and Scott Bonham, who was the founder of GGV, Granite Global. And they have exactly opposite advice for me. So Scott has been a constant source of advice to me, saying, you need to get a partnership, you need to grow, you need to raise a larger fund, you need an entire another tier in the firm. And Jim Anderson's advice always is, don't fix what's not broken. And I literally sometimes have lunch with them and I come back and I revisit this decision. But so far, it's always been a solo GP. For things like speed, efficiency, but also more important than speed, you can genuinely be an iconoclast. you can make controversial decisions, which might take you a while to make, and I've made a few in my portfolio at Engineering Capital, and that is much easier to do when you're a solo GP.
Any sort of, obviously, you're 10 years into this journey and a very successful journey. You're deploying Fund 4. You're past the bumps, right? It's a business that you have built very successfully. So for another, let's say there's a partner at a larger firm that is thinking of taking this step, what would be the most important one or two things that you would like to point out? Consider these two things before you take this decision. What would they be?
Yeah, so the two things which I would say are, number one, you have to understand your personal work style. You have to know whether you are comfortable being lonely in a very, very lonely business. Even in a partnership, you are lonely. I mean, venture in general is a lonely business. And so that's part of the reason why I believe partnerships will continue to be the dominant organizational metric and the way firms are organized. And so you are going to be lonely, and you'll be very, very lonely. And do you have a work style that supports that? So for example, when I want to make a really difficult decision, my work style is I go for a walk with my dog Teddy. And she's a wonderful listener. She always agrees with me. She's willing to walk as long as I want. And I come back with a decision. There are other people who want to have a conversation, who want to talk to someone about it. And so depending on your work style is going to be very important. Number two, what type of a portfolio do you want to build? Are you going to make controversial decisions? You can be successful in venture. Making many different strategies are successful. I would submit to you that no disrespect to my host over here, but Sequoia and Benchmark are two of the best firms in the world. Okay, I think we would all agree that they are, if not the best, one of the two best firms in the world.
So different.
And they're exactly the opposite, right? One's literally a partnership of three people who just hired their fourth partner. And Sequoia is this giant, enormous organization which has a quote-unquote CEO, a chief steward. So you can practice venture in very different firms. And if you study Greylock and Andreessen, you'll come to completely opposite conclusions about how venture is practiced. So you have to understand how you're going to practice the craft. And you can be successful doing it as long as you understand what you're doing and you're playing to your strengths.
So, which is a good segue to your strength, one of your strengths. You have many. And I really admire the hyper focus that you have. I mean, you're a very focused firm, and focus is important in any business, particularly our business. Why does the world need another venture firm? You answered that question. So you've been very focused. Let's talk a little bit about that. What is that focus for folks that may not know you? What is your specialty and your focus?
Pre-seed or seed, first money in software companies, taking technical risk with technical insights and technical founders, primarily in the Bay Area, which have capital efficient business models in these days, mostly AI, cybersecurity, data, and what I'm calling end of the x86. In other words, 4 broad themes that I'm always looking at. So yes, I am hyper-focused. That's a lot of qualifiers, which excludes 90% of, quote unquote, the deals that are out.
Right. So I want to come back to the capital efficient because that's a very interesting and controversial topic these days, right?
Very controversial and goes back to, we have to make money. Our job is to make money.
I don't think we're going to disagree there a lot, but there's a lot of other opinions floating around in the market. So we'll come back to that. Before I come back to that, would it be fair to say that when you say technical founders, your investments are largely below the application layer, or do you also do business applications?
Yes, that is true, but that is a side effect of the strategy. In other words, I'm happy to do an application if it meets the characteristics, but most of the time that's not.
Okay, below the application layer. And this is an area that is near and dear to my heart. I'm an old database person. Anshu is an infrastructure software person. So that's where we also overlap in our investments together. So talking of that, that is not an easy area to invest in. So that's why the world needs engineering capital, right? It requires a technical understanding to be able to recognize a technical advantage. And most of the time, you're sort of investing behind some technical insight in a very complex and convoluted tech stack, right? I mean, you're sort of playing either in an existing tech stack and there's some insight to make that stack better, or you're working towards the evolution of the stack as we are seeing right now to a new stack, right? So stack investing is not easy. What do you look for? There are lots of engineers with good technical credentials, with technical insights, but between an insight and a business, there's a big gap, right? So what is it that you're really trying to tease apart in that first meeting? You meet an engineer, and what is it that you're looking for in that first meeting that tells you yes, or not now, or never?
Well, 99% of the first meetings are not going to result in a second meeting. So in the first meeting, for me, it's always about the person. Is it like, am I sitting across from a person who I feel is on a journey that I want to be on? And these are very special people. Entrepreneur. There are many entrepreneurs now. They used to be few and far between. It's become more popular, but it hasn't become easier. It's a very hard journey. It's a difficult journey that only special people should take on. I actually think there are too many people who are trying to be entrepreneurs, and they will live to regret that. And that's okay. I mean, that's part of how, societies and economies evolve. The first question for me always is this a person who would respond to the ad that I run on my website? I don't know if you've had a chance to go see it, engineeringcapital.com. That ad was inspired by an ad that Sir Ernest Shackleton, who was recruiting people to go on an expedition to the South Pole, ran. And so I'm looking for people like that, people who signed up to go with Lewis and Clark, undaunted courage, walk across the continent and, discover an entirely new continent. So the first question is always, is this a special person who is going to try to build something very special? And then, as I mentioned, is there a technical core? Is it something which is a match for my fund strategy? That's usually something I can tease out in the first meeting. And so that's really all I'm trying to do in that first meeting, is make those two basic decisions. And then, there's always a second meeting, right? The good news is I don't have to decide in the first meeting. All I'm trying to decide is, am I going to spend another hour on this place?
The first meeting is about getting the second meeting for founders.
Exactly.
Right?
Exactly.
Yeah. It's so true. So let's keep peeling that apart a little bit. So you like the founder, you want to work with them for the next 10 years. So there is that personal connection, respect, working style, all those things that you're trying to suss out. Is this a strong athlete? Are they prepared to both run a sprint and a marathon, go the distance, have a big vision, won't give up, et cetera, right? So
all those elements that you identified.
Right,
exactly.
Right. So
do they have the education, the experience, the domain knowledge, the hustle, the sales skills, the technical insights, the jack of all trades, willingness to throw yourself into a new problem? All of those things have to be present to be a good entrepreneur.
And then very strong insights, but at the same time open to listen to the world and adapt, right? So,
deep conviction in a contrarian way while having an open mind. Those are contradictory elements. And you look for those two things. You look for those two things.
Very true. So now let's so all of that has passed. Now you're trying to assess, is there something here, right? Like, is there a there? So what is that? Again, because applications are much easier to understand. Is there a market here? We all have we are inch deep, mile wide, and we all have basic understandings of many markets that we can sort of make a very quick decision, small market, big market, whatever, and filter very quickly. I think the places where you invest that's harder, right? So just as you're progressing through second, third, fourth meetings, what is it that you're trying to suss out? This is there's no product here, correct?
Right.
Most of the time,
right? 100% of the time, there's no revenues, there's no product that has been built, and so yes, I'm looking for the barbell set of questions. The long term, is this a potential, and it's all potential, standalone large company that could survive and become a big business if everything fell into place? There are many ifs along the way. As you know, most companies don't make it to that stage. I've now had the privilege of having companies, get to that first $1 million of revenues, $10 million of revenues, $100 million of revenues, $1 billion of revenues. So I've seen board decks with, all those numbers in them. And it's just every zero is just a totally different journey. And so you're betting on every single one of those falling out in place. So is that possibility exist? That's one question. And near term, a question that I always like to, spend time with the entrepreneur on is is the next year and a half real? Like, is this actually going to happen? The next year and a half, you should have a very good sense for that. If you're an entrepreneur who's raising venture capital, you're not going to get funded for more than 2 years at a time. And so your next year is absolutely critical. It's make or break. Are you going to get there? Are those milestones crystal clear? Is the path to those milestones obvious? And have you thought correctly about it in a way that I believe in, both technically and from a business perspective? You know, I mentioned capital efficiency earlier. That comes into play over here. I am investing in companies where they are going to do something interesting in that pre-seed seed round. So in $2, $3, $4 million, you're going to build something. With a 2-pizza team, you're going to build something and get commercial validation of what you're going to do. There are companies where that's never going to happen, and those are not a match for my strategy and my fund.
So you've really the founder has nailed the first 2 years. I mean, they have absolute, total visibility, understanding, minute understanding of the business, of the product that needs to get built. The 2 years are totally mapped out. That's preparedness, right? So you're really looking for how deep and how prepared, how much work have they done. So there's a lot there. So that's wonderful. I think that's very helpful insight for founders who are listening to this.
Another way of thinking about it, Nilanjana, is does the founder have the vision and the detail-oriented micromanagement to get there, right? The vision is the big thing. It's actually easier to have a bigger vision, in my experience. It's easy to have a big vision. I mean, AI is going to be gigantic in 10 years. We're going to have many more self-driving cars in 10 years than we have today. But nailing that detail-oriented execution is really, really hard.
Right.
And I'm looking for the combination. If those two things connect, then it can be an amazing opportunity.
The idea is a small percentage is the execution. That's the difference, right? So let's now switch to the capital efficiency side. Our business ebbs and flows. We've been here before many times where how much money I have raised is a marker of success versus what I ultimately deliver as a multiple of invested capital, right? For many, that's seen, and particularly sort of new founders entering who are first-time founders. They're reading everything that's out there, and everything's telling them that the mark of success is how much money I've raised. So in that sort of sea of, capital is a marker of success, how do you find these founders? What is that conversation like that, no, you really need 3 million to prove your product out, or 4 million, or maybe call it 5 million? I mean, how does that conversation go? And tell us a little bit about those conversations these days, particularly.
Well, for government, regulatory, and structural economic reasons, the amount of dollars coming into the private market has increased and is going to continue to increase. We have a fundamentally broken IPO market. It is highly unattractive to take a company public and to run a public company. And I completely fault our government for that. They have messed up what was really the golden goose. It's still surviving. We still have, public stocks, but they're half the number than they were 10 and 20 years ago. And most people don't realize that. We literally have half the number of public companies in the United States than we had 20 years ago. At some point, I pray and hope to God that we will fix that problem, and that will start addressing the underlying root cause over here. But that's above my pay grade. I have to live in the market that we live in. So in a private market, where the incentive for many general partners is to actually just deploy more and more capital because that results in more and more fees. Unfortunately, for both private equity and venture capital, that is true for large firms sometimes. And so the incentives are skewed, and that is why you hear a lot of crowing and a lot of publicity about the amount of dollars raised. And let's face it, there is some correlation between dollars raised and returns, but it's a very weak correlation, especially for the founder. And if you ignore secondaries, which is another, I think, dysfunction that exists right now, fortunately still relatively small, founders really only make money at the exit, should really only make money at the exit. And so all the money you raise is working against you. And that's the first thing that I want a founder to really understand, that the less the money with which you get to success, the richer you're going to be, the more successful you're going to be. Heidi Rosen has a wonderful blog post on the founder who sold a company for $1 billion and didn't make any money, because that's what happens if you raise a lot of capital along the way. And I have founders who sold companies that nobody will remember. The company got sold for a few $100 million, but they never raised any capital, and now they're running their own family office because they own most of that company and nobody's heard of their company. Raising money is actually inversely correlated with founders making money. Secondly, the best and most interesting technical projects in the world have always been done by a two-pizza team. So the fact that you need capital is not true. And I know there's an exception if you're training a large AI model, or there are some areas where you can deploy capital usefully. In most cases, you don't need that. You need a two-pizza team and you need the 10x programmers, and that's who's really going to build the product. That's how Google was built. That's how VMware was built. That's how Facebook was built. That's how the greatest software companies in the world are built. Bill Gates and himself, the two of them, personally wrote the first product at Microsoft. So that has not changed in the nature of software. Right. And so capital is not the constraint. The insight and the willingness to work and is really where the constraints are.
I would 100% agree with that. That's why both of us are early stage investors. That's why this is the most interesting place to be a venture capitalist, right? Because that's where the advantage is. So then let's talk about upstream capital. All right. So I agree with you, two pizza team to really get to that first product, prove that the world needs this product. This should not require, 100 million of capital, with the exception of a different type of, we all talked about that. So now let's talk about sort of how do you as an early stage investor think about the capital that's wanting to come into your company, wants to, doesn't want to, there's advantages and disadvantages there, right? And again, founders get conflicted because we too are conflicted. Like our business sometimes gets evaluated not on of course on DPI, but on TVPI. We like the markups. We like if Sequoia comes in and wants to put 100 million into the company. But how do you as an early stage investor, as a board member, guide your founders on when it makes sense to raise that next 50 million or when they should just raise 10?
So first, let's recognize that the engineering capital strategy is designed to eliminate or at least reduce potential conflicts to the maximum extent possible. I run a hard cap fund. I've been oversubscribed every single time. I've had a hard cap every single time. I've always had a single close, et cetera, et cetera. It's all the luxuries that a GP has in terms of fundraising. So fundraising is not the issue. And the strategy is the issue. The question is, what's the right amount of capital that I believe is going to accomplish my personal greedy goal, which is maximize the multiple, right? Now I'm just since I've hard capped the funds, the question is, how can I maximize the multiple? And it turns out that the highest multiple for me is actually also the highest return for the founder in almost all cases other than secondaries or some very special strategies where capital becomes a weapon in the market and things like that. So with that caveat that there do exist strategies where that can happen, and there are cases where that is the case, in general the founder and I are very aligned. And so we're looking for the highest quality capital, which will allow us to move with the highest velocity to build the largest company. Those things are sometimes in contradiction with each other. So you have to find a compromise between them. And that's a conversation which is a one-off, case-by-case, individual conversation based with the founder, if we have the luxury of choosing. Many times we don't have the luxury of choosing. It's like, oh my God, thank God you got a term sheet. Let's take the money. Let's move on. Let's, live to fight another day. I mean, that happens too. So I definitely have some gray hair from those conversations. So let's face it.
That's more the norm than
it is more the norm in venture capital. That is more the norm, no question about it. But when you do have the privilege, and I'm very fortunate, I've had that privilege also, when you literally have people calling you up and you get to choose who you want as an investor, then you can have a real dialogue on what is the most efficient, best, wealth maximizing opportunity for you, What's the best for the company? What's the best for me? And then let's get to a compromise on it.
Capital efficiency, starting with, a small amount of capital to prove the product, and then choosing to raise more or less depending on what the business reality is. I mean, that's a disciplined way to build a successful business. You're saying you're closely aligned to the founders on the cap table. I mean, we are the same, right? We are the closest on the cap table to them, so we are completely aligned with the founders. And that's exactly the way to think about building a business, because it's about value maximization. 100% agree.
I've publicly stated, Nilanjana, I'm never going to lead a Series A. I have no signaling risk. I will always partner with another firm. So these are all publicly, sort of written in stone kind of claims that I have made, which makes it much easier to have this conversation with a founder than, for example, when you're at a multi-stage firm, when the question becomes, well, why don't you lead the next round? Maybe you want to do an inside round. Maybe you want to do more than your pro rata. None of those problems, I've eliminated all of those just by virtue of my strategy.
Right. And then there's full alignment and clarity between you and the founder, which is so important. So let's then move to this current moment we find ourselves in, right? So you've been backing technical founders since 2015, or obviously at Foundation before that, but at Engineering Capital. So now we find ourselves in a world where code is getting generated pretty well by LLMs. We're in the world of agentic automation. They're almost, in a way, for the question I'm asking, they may be two very different and opposing factors, right? How do you think about the quality of the teams that you're backing today in this post-agentic world? The engineers you're backing today, the teams that you're backing today versus ones that you backed, let's say 5, 6, 7 years ago. What would be different in this world? So
teams have always been important. The quality of the team has always been important. What has changed because of AI and because the very nature of software development itself is changing along the way is that teams are getting smaller, more concentrated, speeds have gone up, and therefore the quality has become exponentially more important. So what used to be a 100-person company is now a 20-person company, a 30-person company. So every individual is 3 times more important. And the reality of teams is that all people are not equal, which means the most important person is now 10 times more important than what we used to originally call a 10x programmer. In other words, is now 100x more important on an objective basis across the way. So the quality has become even more important, the concentration has become even higher, the risks are even higher, and the payoffs are even faster. So that's the nature of where we are headed. I don't see that changing. And so teams are important. I'll make a second observation about teams. There has been a lot of discussion, especially in a post-COVID world, of remote teams, of distributed teams, geographically distributed teams. I am highly partial to local co-resident teams. I think the level of communication that occurs in the core when the team exists together, it makes an enormous difference. Now, that doesn't mean that I'll never back a distributed team. I have done that in the past, and I've been successful doing it in the past. So it's not a hard and fast rule, but it is definitely a bias that I have. And I really want to understand, why are you distributed? What is the constraint that prevents you from being together? Because if you can be together, you will definitely have an advantage. So those are the two things in the nature of the team that I think are very important to consider.
You need less engineers to get to the product. I'm just shorthanding what you just said, right? Because of the progress with LLMs. Less time and less engineers needed to get to a product that also lowers the barrier to entry. Many more similar competing qualified engineers can build the same product, get to market faster. Does that lead you to think about different components of the founding team now? Is the ability to sell faster? I mean, do they have to get to revenue faster? Do you think of the team a little bit differently in that sort of super faster to time to revenue world? Do you think they need to have more business skills? Do you assess for that? Do they need to bring in someone sooner if they haven't sold before? Like, how do you think about that? Because it's good and bad, right? The bad of it is that you have far more competition, I'd argue.
Rather than thinking of this phenomenon, which you are absolutely right about, rather than thinking of it as a lowering of the barrier to entry, what I like to think is that it has raised the bar on the barrier to entry that you have to create for yourself. The expectations on how you will think about barrier to entry are now more sophisticated, more nuanced, and you have to execute against that higher expectation of where you will be. Is speed a part of that? Of course. But just speed is rarely sufficient to be a barrier to entry. I think you have to have more than that. You have to have some insight. You have to create a barrier to entry by bringing together different elements. Perhaps you have some technical advantage. Perhaps you have some business or market insights. Perhaps you've made some partnerships, go to market, and perhaps you are executing better than other people. And perhaps you have a cost advantage, etc. So you have to bring all these things together to build a barrier to entry. They can be built, but now they are more sophisticated and more complex.
Maybe that's a good place for an example of a recent investment you've made where you have that, you see that it's a modern tech stack play. And, if it's in stealth, that's fine. You can just maybe talk in abstract, tease that apart a little bit.
I think it's easier to talk about a company we just recently exited because now the story is very well understood. And so we can take that as a case study. I was the first investor in a company called Robust Intelligence. The founder actually was at Harvard in your neighborhood. When I met him, he was a postdoc, assistant professor, and said, I want to leave and start a company. And I was like, wow, you're amazing. I mean, his insights were just so amazing. And so I ended up becoming the first investor in the company. And they ended up moving here, actually. So Yaron Singer, ended up moving to the Bay Area, which was, not part of the original plan, but for whatever reason. Sequoia ended up leading the Series A. Tiger led the Series B. Cisco acquired the company last year. And today, what is called Cisco Intelligence is actually all of Robust Intelligence. So, that was the insight over there. Now, notice I said that the company started with someone who was an assistant professor, a postdoc at Harvard, at a university, who was doing research, right? So clearly they had some technical ideas. They had some technical insight. And at the other end of the spectrum, I'm telling you today, what is Cisco Intelligence is basically Robust Intelligence. Yaron actually runs that for Cisco now. And so clearly they built a business. They found product market fit. They had that commercial thing that they had put together. And in between those two things, they had built an absolutely unassailable product, a product that was unique, that was solving a real customer problem, and we had a technical advantage on, a true research advantage on. And with, protected with the usual things, patents and trade secrets and code and all of those things.
Fantastic. That's a fantastic outcome, great example, and congratulations, obviously, to your own and team and to you as an early investor.
Yeah,
Those are very satisfying moments.
It is a satisfying moment, but there's always that luck element, and I'm always grateful that, he chose me as the investor. So yeah,
you were prepared. Preparedness leads to luck. So. Right, as I like to believe. Awesome. So just maybe one element there. How do you think about sort of team evolution? You're backing a core technical team. In your experience, I don't know how many companies you've backed at engineering over the years, but sort of what percentage do you see where you've seen the founder continue to be the CEO at exit, and where they have decided to bring in someone to augment themselves? Just your view.
I love that question because I think VCs don't spend enough time thinking about this. Catherine, before she became a venture capitalist, was actually a recruiter. And so she would always talk about the individual and the CEO of the company. I am extremely proud to share with you that 100% of engineering capital companies are run by their founder CEO, with the exception of one company where the founder CEO is now the CTO of the company and he recruited a CEO to run the company. So I think the CEOs are incredibly important. And I think founder CEOs are especially important and special people who can do that. And by the way, this includes companies that are literally seed investments that I made, last quarter or 6 months ago. And it includes obviously public companies like Rubrik, large businesses like, Menlo Security or Kentic or Evinced, companies which are doing 100 million ARR. And these are all public numbers, which are still run by their founder CEO. So one of the things which I'm doing in that first meeting that we talked about early on is that, can I imagine this person ringing the bell on NASDAQ? Can I imagine this person having a board deck with 100 million ARR in it, And I think that's really, really important to think about. So all VCs don't agree with me. Certainly, some VCs see CEOs as almost disposable or replaceable in some cases. I don't believe that.
That is sort of that's a North Star. Totally agree. Well, this has been a great conversation. I also know from our interactions and from listening to your other interviews that you're an avid reader, not just of books, but of papers, and sort of you're an engineer, chief engineer in many ways. We are at a very, very interesting, perhaps the most interesting time of our careers, right? I mean, this is a gigantic platform shift that has, we're talking about AI, obviously, which has enormous power to do good, to do not good. And I'm 100% believer that the power to do good is going to come from, to a large part, from the decisions that founders will make, the companies that they'll start, and the decisions that'll be made around the table as those companies make choices, right? Whatever it is, cancer research to energy efficiency, there's so many problems that are now possible to be solved at a gigantic scale. So with that, I think, all of us are looking ahead, staying educated on the pros and cons of the technology, the power of building and of destruction. With that framework in mind, looking to the future, will we have AGI? What should we be looking out for? What should we as founders and investors be aware of? With that framework, name a paper or a book that you have read recently that you recommend all of us to read also.
How many hours do we have left to discuss? You're going to make me choose only one. So let me choose.
No, okay, two. All right, two.
So I'll start with a paper that I read recently that is actually, again, from your neighborhood. So it just came out from MIT. I actually have it printed out over here. I think this is a paper everyone should read. It's called Science in the Age of Algorithms. It's a very interesting paper that just came out. It really tries to answer the question of how will science change because of AI? And ultimately, science is at the root of all progress, right? I mean, if you look at human progress on the vast scale, we trace it back to science. And so how will science change in an age of AI? And it's a very interesting paper. It's very accessible. You don't have to have a deep tech background to read the paper. It's very well written. I recommend if anybody is interested, they should read it. Another book, if you want to read in terms of, the impact of AI, is actually a relatively older book that was written by Professor Ajay Agarwal and Josh Gans. Power and prediction, and then of course, AI, prediction machines, just nailing first principles on what AI is going to mean. Just sort of what does a prediction machine do and what is its impact going to be on the economy? Because they do it from first principles, these are books that will stand the test of time.
Yeah.
If they really,
and very accessible again. That one I can attest is very accessible.
Yeah, so they're very accessible books. They're easy to read. And since you gave me two, I have to take three, of course. I have to take the bonus. I'm the greedy guy.
Go for it.
Another book which, despite its title, is incredibly accessible is Why Machines Learn, the Math Behind AI. Now, you think that's a math book. It's written by a math professor. So you're like, oh my God, do I want to read a textbook on math? The magic of that book is that it traces the history of the math that, we run with what makes a modern AI work. But the wonderful thing that the author has done is in the first 2 or 3 pages of each chapter, they've given the intuition behind the math. And so you don't have to read the math. You can just read the intuition and you get to see, why do LLMs hallucinate? Why do we do this crazy amount of training? Where are those trends going? And what I believe that, scaling laws are ultimately going to break down, which is a controversial opinion. I think that's not something everybody would agree on. But Why Machines Learn, the elegant math behind AI is also just a fascinating read.
Fabulous. Well, those of the 3, I've read 1, so I got 2 on my nightstand now as we speak. And with that, I'd like to thank you, Ashmeet. I always learn something and a lot in each of our conversations. So this has been most enlightening for me, and I hope for our listeners. Thank you for doing this, and I hope to have you back for a future conversation, perhaps talking about AGI in the not too distant future.
Thank you, Nilanjana. It was a pleasure.
Wonderful.